Welcome, crypto traders, to another exciting journey into the world of technical analysis. Today, we're diving deep into one of the most powerful tools in a trader's arsenal, candlestick patterns. If you've ever wondered how to decipher the language of the charts and predict potential price movements with accuracy, then you're in the right place. In this jam-packed video, we'll be unlocking the secrets of candlestick patterns, guiding you through each pattern step by step, and providing easy-to-understand explanations suitable for beginners. By the end of this video, you'll have the skills and knowledge to confidently identify and interpret these powerful signals in your own trading journey. So grab your notepads, buckle up, and get ready for a roller coaster ride through the fascinating world of candlestick patterns. But before we dive into the nitty-gritty, don't forget to hit that like button, subscribe to our channel, and ring the notification bell to stay updated with our latest content. Alright, traders, let's light up the charts and illuminate your path to trading success. Are you ready? Let's do this. A doji is a candlestick pattern characterized by its small body, indicating that the opening and closing prices are virtually the same. Traders interpret the appearance of a doji as a sign of market indecision, representing a temporary equilibrium between buyers and sellers. To implement a doji in trading, traders often look for confirmation from other technical indicators or candlestick patterns before making trading decisions. For example, a doji that appears after a strong uptrend may signal potential exhaustion among buyers, especially if it's accompanied by high trading volume or overbought conditions on oscillators like the Relative Strength Index (RSI). Conversely, a doji after a downtrend could indicate weakening selling pressure and potential for a reversal, particularly if it forms near a significant support level or key Fibonacci retracement level. It's essential to consider the context in which the doji appears, such as its position in the trend and the preceding price action, to make informed trading choices. The hammer and hanging man are candlestick patterns characterized by a small body and a long lower shadow, resembling a hammer or hanging man. A hammer occurs at the bottom of a downtrend and signifies potential bullish reversal, while a hanging man appears at the top of an uptrend and indicates potential bearish reversal. To implement these patterns in trading, traders typically look for confirmation from other technical indicators or price action signals. For instance, a hammer with a long lower shadow that forms near a key support level or Fibonacci retracement level may signal a strong buying interest and potential reversal if followed by a bullish confirmation candle. Conversely, a hanging man at a significant resistance level or after a prolonged uptrend could suggest weakening buying pressure and potential for a bearish reversal if confirmed by a subsequent bearish candle. It's crucial to wait for confirmation before entering trades based solely on hammer or hanging man patterns to reduce the risk of false signals. Shooting star and inverted hammer. These shooting star and inverted hammer are candlestick patterns characterized by a small body, a long upper shadow, and little to no lower shadow. A shooting star appears at the top of an uptrend and signifies potential bearish reversal, while an inverted hammer occurs at the bottom of a downtrend and suggests potential bullish reversal. To implement these patterns in trading, traders typically wait for confirmation from other technical indicators or price action signals. For example, a shooting star that forms near a significant resistance level or after a prolonged uptrend may signal waning buying pressure and potential reversal if followed by a bearish confirmation candle. Conversely, an inverted hammer near a key support level or after a downtrend could indicate increased buying interest and potential reversal if confirmed by a subsequent bullish candle. It's essential to consider the context in which these patterns appear and wait for confirmation to avoid false signals. Bullish and bearish engulfing. The bullish and bearish engulfing patterns are candlestick patterns characterized by a larger body that completely engulfs the previous candle's body. A bullish engulfing pattern occurs at the bottom of a downtrend and signals potential bullish reversal, while a bearish engulfing pattern forms at the top of an uptrend and suggests potential bearish reversal. To implement these patterns in trading, traders typically wait for confirmation from other technical indicators or price action signals. For instance, a bullish engulfing pattern that forms near a significant support level or after a prolonged downtrend may signal a shift in market sentiment and potential reversal if followed by a bullish confirmation candle. Conversely, a bearish engulfing pattern near a key resistance level or after a prolonged uptrend could indicate a change in market dynamics and potential reversal if confirmed by a subsequent bearish candle. It's crucial to wait for confirmation and consider the overall market context before entering trades based solely on engulfing patterns to reduce the risk of false signals. Morning star and evening star. The morning star and evening star are three candlestick reversal patterns that occur at the end of a trend and signal potential reversal in the opposite direction. A morning star consists of a long bearish candle, followed by a small-bodied candle doji or spinning top indicating market indecision, and completed by a bullish candle that closes above the first candle's midpoint. It signifies potential bullish reversal. Conversely, an evening star has the same structure but appears at the top of an uptrend, signaling potential bearish reversal. To implement these patterns in trading, traders typically wait for confirmation from other technical indicators or price action signals. For example, a morning star that forms near a significant support level or after a prolonged downtrend may signal increased buying interest and potential reversal if followed by a bullish confirmation candle. Conversely, an evening star near a key resistance level or after a prolonged uptrend could indicate weakening buying pressure and potential reversal if confirmed by a subsequent bearish candle. It's essential to consider the context in which these patterns appear and wait for confirmation to reduce the risk of false signals and improve trading accuracy.